This video shows a small gap up, and I do videos like this so that you can see why you don't get a big gap up or a big gap down for other videos. I think it's important to see these differences. It doesn't do you any good if you always see the perfect big gap. So this example has I'm under a normal setup here, or somewhat normal, I guess, for how I explain these things. I've got 3 daily charts. The right chart has the all 5 sub charts like you would see on the master platform when you open up the platform or open up your charts. And then the other 2 are broken down so that we have a little bit more visibility in looking at the lines on the YouTube. Excuse me. Now, I'll just point out here real briefly just so that you see it. When you're under this stock here is a couple dollars, $1.80, and right now it's in the $2 up in here in this. We're in April of 2017. And I just wanted to show you down here, when you're in a small price stock like under $5 or under $7 or whatever it is, the power red looks really big. It makes really big movements and stuff and things like that. And I just wanted to point that out to you. I've mentioned it on other videos, but sometimes you don't see that. Now, you can see that from the green vertical line, we have the day after this is a small doji green candle. I mean hardly any price movement at all. And then it gaps up and goes up really strong the second day. And I want to make you aware of what we need to have in the gap 3 pattern situations. And as you know, you need 3 patterns to qualify for gaps, and depending on the supporting evidence that you have, you then can identify how the gap might be. Excuse me. Now, the 3 patterns are having a number of identical patterns, having a down touch in the trend chart, and having the power 4 in a proper location with a designated pattern that fits in the parameters that we have established for a proximity group. So you have the proximity group, the down touch pattern in the trend chart, and the identical pattern in all 5 subcharts. And so those 3 patterns then, if they have the right conditions, then give us the go for a gap up in this case, and obviously different situations apply for gaps down. The first thing I will tell you is, after counting, and hopefully I counted correctly, I've got 12 2-day TOC patterns. That qualifies in the identical pattern category with a majority. 12 out of the 22 makes a majority. So it's technically a 1 pattern setup. It also has 4 1-day BOC patterns. So it's kind of like a 2 pattern group, which is good, because we then have 12 and 4 makes 16 identical, or 16 patterns that are moving in the same direction. However, when we go to the trend chart right over here, we see that there is no down touch. Remember, in the trend chart, you have 5 possible down touches. Red, green, and gray can down touch the 3 trio lines, the yellow, pink, blue. or they can down touch 0, or they can down touch what we refer to as under 0. There's nothing that's down touched, but the basic premise behind it is that the lines are only down 1 day, and in some cases 2 days works. With the red line, the trend red and the trend green are only down 1 day below 0, and in some cases it still works with 2 days below 0. When you have a whole bunch like you have here, you obviously are that it is not qualifying as, technically speaking, as a down touch. Although all three, gray, red, and green in the trend chart, are below the 3 trio lines. In the power chart down here, you can see that Power Zion is in a 2-day BOC pattern, a 2-day TOC pattern going down, and that's the majority of the indicators as to the identical pattern that they are in. The proximity group is also above the power orange line, which is what we need for a gap up. But we normally, in gaps up, when we get a good gap up, the power Zion is under the orange, not above the orange. Now, it works with above the orange as well. It's not a situation that I would avoid not buying, because it's close enough where it appears to be a gap up based on the power chart itself. Okay? Excuse me. Then, right now we've established that we have 12 identical patterns qualifying us for a 1 pattern. We have the proximity group in its place. Also, if you look at this chart over here, you can see that the power orange and the power green are minus 0.14 and minus 0.17, which means they are negative, but they are still 0.03 apart. Hundreds and hundreds of gaps that I've seen have power green and orange at 0.03. They go up all the way up through 0.07 and 0.08, and we normally designate to the cutoff at about 0.15. We want to see power green and orange close together, both going up. They're technically supposed to be near 0. And as you can see in this example, they are far below 0. And that's probably why we have the power Zion up above the power 4. Your power 4 being your pink, blue, white, and yellow. And so the fact that it's up above it is not unusual in our determination for a gap up pattern. Back to the trend chart, we have, and you may have heard me talk about it before on other videos, maybe you haven't seen those videos. When trend gray is lowest and in a down spike, like we have here, we basically have a 2-day down spike in the trend gray. When trend gray is lowest, it is a good sign for an uptrend. And if you had a real strong spike that was substantiated with zip red, like 50 or 70 points or whatever, then it would be what I would refer to as a next day up, a 1-day up pattern. An uptrend, when I say uptrend, means a 2 to 3 or 5 days up. So a next day up is 1 day, and an uptrend is more than 1 day. Now, we don't have a down touch in the trend chart, so technically that does not let us qualify it as a gap up proper conditions and or we identify as proper conditions. However, as we know that the trend gray is down, we know that the proximity group qualifies, even though it's low. Keep in mind, at this point, your power green is at minus 0.14. The majority of the time, the power green and power orange are right next to zero, usually slightly above zero. When they're under zero, that gives us that's a question mark about being a gap up, especially at this distance. But when everything falls into place right here with the identical indicators, there's 12 of those and 4 in the other group. We've got a lot of identical indicators, which means we have a lot of supporting evidence. Keep in mind, if you had 19 identical indicators, you've only got 3 more lines to have supporting evidence in those identical indicators. They could be a different pattern that would also point up, or they could, whatever the case may be. So the point I'm making is that when you have 19 identical indicators, you've got a lot of supporting evidence. And so, at least in the one pattern category, you always need the 3 gap patterns, the proximity group and the down touch in the trend chart. And so now, if you go over and you look, for example, in the zip gray chart, remember zip gray is a leading indicator. I said that wrong. Zip red. Zip red is a leading indicator, and its pair is zip gray. They both are very fast. They both are leading indicators. Zip red, gray, and swing pink are the 3 fastest indicators, and they're all 3 leading indicators. And oftentimes there are several other lines that can be leading indicators, especially in your power chart and your swing chart, your power chart and your zip chart. In this example, on the green line, we actually have zip red in a BOC pattern. Everything else has been in a TOC 1 day or a TOC 2 day pattern. And so this is an opposite turnaround, but it's actually or not an opposite turnaround. It is a pattern that is opposite of the TOC, but it is still a pattern that drives us up next day. And you've also, if you may or may not have heard, if you buy something like this and the next day you get like this doji green candle the day after the green vertical candle, a vast majority of time, just hang on to it. It's going to gap up. It's like there was another day of battle between the bears and the bulls, and then they took over the following day. And so that's what happens. Depending on the length of the candle that you have on this second day, where the line is right now, where the arrow is, if that second day has a really tall upper tail on the candle, then it can gap up the next day a little, or at least trade above where it's been on this day. It's not a strong indication that it's going to stay up, but in this case here, the third day after the vertical line, right on this line here, we have a T-top candle, and it's near the very top of the previous day's high. The following day, before it starts back down, it actually has a gap up red, and then looks like a red top. There's no tail on it at all, and then it went down. And by the way, this day here is an excellent example. If you look in the price chart, we have a low angle up on all 3 price lines, with the green as highest, telling us that next day it's going to be down. And that's reflected elsewhere in the swing chart down here, and and I'm sure you can. I'll bring this down a little bit. On this third day on On this green day in the trend chart, we actually have peaks. We haven't identified that there's a turnaround there on that last green candle day, but on these we have identified a turnaround in the price. The zip went up to 100, and it is looks like it is a pinpoint because Zip Pink snuck up underneath the green when it was at 100. Oftentimes when that happened, the price starts down. The following day here, however, is we have Zip Green at 100 with a red candle. And that's a real strong indication that you're going to enter a downturn in the cycle. Because Zip Green is your buyers in and out of the market. When Zip Green's at 100, then a lot of people are coming into the market, into the stock, excuse me. And Zip Zion is also coming up, and then Zip Zion is the grandfather. Zip Zion tracks buyers in and out of the market as well. When Zip Green is at 0, there are a lot of people leaving the market, and when when Zip Zion is at 0, you got a huge amount of people leaving the stock. So you can see those identifications. If you brought this thing down more like this, you can, like on this day here, the green candle day. Let me go back here. The third day after the green vertical line, this is the peak. You can actually see trend red in a low angle up. The low angle does not show as much as it does when you're over here in the price chart and the zip chart and the swing chart. But it's there when you look at it. It just, trend red and green and gray are also very reasonably fast lines. And they just have more push to them. In other words, from the 2 days that distinguish trend red as a low angle up, the line length is longer. So it pushed it up higher, but it's still a low angle up. And likewise, when you see here the power chart, remember, power pink is a deep cycle indicator along with power blue. They run together. Most of the time when pink is highest or pink is lowest, that's the peak. When you have a peak, and I hope that is clear. What I was trying to say is, because you have all of this other information that tells you it's a peak, you now know that pink is on a peak. That's a deep cycle. Swing gray is the other deep cycle, and those I think of pink and blue, power pink and blue, as a deep cycle indicator, as one deep cycle indicator, and swing gray as the other deep cycle indicator, telling you deep cycle highs and deep cycle lows when they're occurring. And so we've identified this, but the key thing in the power chart, if you look closely here, you can see that while the power 4 are going up, what's happening? The power Zion is down. It's divergent. And that's oftentimes, again, when we see gaps up where the power Zion is under the power 4. It works best if Zion is under power orange. But sometimes, for example, in the pattern where you have 3 days down, the 3-day down pattern is a parallel pattern with a bottlenose down pattern. It's just that the 3-day down lines did not qualify as a low angle down like you see in a bottlenose down pattern. Because remember, the bottlenose is 3 days down, and even though the middle line is a low angle down. And that's basically how when I thought about putting these things together, I thought of a bottlenose dolphin, and I thought that pattern looks where that low angle is in the middle. I thought, well, that looks like where the eyes would be on the bottlenose dolphin. So Hence, I called it that from almost, I think, from the beginning. But and in this case here, when you see this power 4, I mean, it's telling you, it's a, how do I say this? It's a picture of a gap up, okay? But the problem, or the issue that you've got here is that even though your power 4 are showing you this gap up movement right now, you have power power red right now records a 3.8 value, which is fairly high. Remember, power red never goes below -6, but it does reach heights above 6 when it's above 0. Depending on how your bigger value stocks, like your $100 or $200 value stocks, can have a tendency to be higher when they move in cycles. Above 6 in the power red is what I'm trying to say. Okay, but back to this example, because I want you to comprehend what I'm saying when I talk about a up down down pattern. That is a TOC 2-day pattern. It's like the 12 patterns that we have on this, 12 identical patterns that we have on this example on the green line, vertical line day. Now, when that, keep in mind, that's a divergent pattern when it appears at the bottom of a cycle. And when the right leg is longer, we have more power. And you have to think of the power in the way, like for example, when a bottom of cycle, a normal BOC pattern has one leg down and one leg up, you got a V. And if the right leg is higher than the left leg, you got a BOC higher pattern. When that appears at the bottom of a cycle, then that's a strength indicator, a longer line length indicator that shows us more strength in the upcoming movement. And so that's real critical to identify the difference between the BOC lower and the BOC higher at the bottom of a cycle. Now take a BOC pattern and throw it on a peak. When you have a BOC higher pattern before the peak, in other words, the right leg makes the peak, the reaction is usually stronger in its reversal push because there was a really strong upper push. Think about what happens. You got a whole lot of bulls that were just pushing that price up as fast as they could at the end of the day, and then depending on where the length of the upper tail was, they sold out their positions. It's that before the peak and after the peak issues that you deal with. When you have a BOC pattern, a BOC lower pattern, especially a 1-day or a 2-day, 2 days are more powerful. When you have a BOC lower pattern on a peak, that's a strong indication that things are going to go down. Now, back to this example. We have a TOC pattern at the bottom of a cycle. And so we've got a divergent, a TOCs, that's a top of cycle pattern at the bottom, which makes it divergent. And so that divergence is what, we've got a really strong down push, and it's divergent because it's at the bottom, and it generates a strong up push. You've heard me say it before, hopefully on other videos. When you have on the green vertical line day, you see all this information that you've got, and you go, "Oh heavens, what have I got here? What's going to happen?" I buy into it right away in the morning when it goes down, and it just fizzles the whole day. You got the day after this vertical green candle, you got a doji candle. I mean, it literally hardly moved. When that happens, because you had all that information there, you just you just had a battle between the bears and the bulls that held it in position. The next day is when the big move is going to go up, and it's usually, as long as everything looks strong, stay in that move for the next day going up, because this one gapped up a little bit and then went up a strong amount, relatively speaking, because of the $2 price on the stock. So, but imagine you had 10 or 20,000 shares. It makes a big difference of what you invest in and the value of the stock at that point in time. But those are some of the key things that can help you. One other thing I'll point out here is you've got a right now on this vertical green line. If you look in the ZIP chart, you've got a ZIP Zion that is almost highest. You've got ZIP green in the way because ZIP green is now highest, and excuse me. That when green is above Zion, that's an indication that it is going up. But at the same time, remember, when you have a ZIP Zion, you most of the time when you have ZIP Zion highest, if ZIP green is above it, you can just discount the ZIP green above it and look at what you've got. But in all cases, you want to have the ZIP Zion going down. And when it's going to go down, what do you have? You normally have ZIP Zion above 50. And see, so now you got ZIP Zion down here. ZIP Zion right now is at 27. And that's a pretty tough judgment call to tell, if you're going to tell me that ZIP Zion is going to go down the next day. And so you have that little reflection in an opposite price movement. What it did was you also have ZIP red going up. So there is a little bit on the ZIP chart. Remember, the ZIP lines are the fastest, some of the fastest lines we've got in the whole system. That's why they're called ZIP. And so when you see that mixture of activity, that can be a signal. But it's going to be hard for you to pick that up in the middle of that trading on the following day. You're gonna open up that next day after the vertical green candle, and you're gonna go, oh great, it didn't gap, I'll get in. And you go sit there the whole day and nothing happens. And it's the next day that you would have that. And I normally get out on the following day, because after that doji candle, the following day, I usually try to pick the top and get out, and then find something different. Because there's just a lot of movement in this day. Keep in mind, between this day right here, which is the day after the vertical green line, ZIP red is at 30. On 2 days after you've had this big gap or big green candle movement, and with it dropping back down, look at that long upper tail. After it drops back down, ZIP red is still at 69. So it went up just about 40 points, but let me tell you, I'm not sure. It could have been up to 90 points when it was at the peak. And that's when you'd look at ZIP red and you go, it's 30 now and it's at 90, it's gone up 60 points. Boom, I'm going to get out. And that's what I usually do in a trade like this. And so you can sometimes you'll find these little doji candles, and you can identify with what is happening on them. You gotta have the three patterns together. That's very critical for a gap up. And obviously this example did not gap up. We did not have one of the 5 examples that qualify the down touch as the possible criteria for the 3 patterns that have to be there in order for the gap up to occur. Also, you may not pick up on it right away. You have all 3 the trio lines, the yellow, pink, blue. They are under 0, not above 0. When you have a really nice gap, 99% of the time they are above zero. And so, I mean, there's just a powerhouse of information inside of these sensitive indicators. You just have to pick up that information, see what's there, identify. I mean, I would have bought this thing, I wouldn't have probably put a whole lot of funds into it, but I would have considered picking this up. Even on this day, if I found this on the green candle day before the market closed, no, wait a minute, I wouldn't either, because it didn't have the gap up. I would have waited till the next day, but because everything went up and I had the trend gray line on the lowest. When you have trend gray physically lowest, you're in a pattern that goes up. You also note here that if you look back a little bit, you can see that the trio lines are somewhat in a three-step pattern. It went down here, it went down again in this general range. You might say the low point is over here, and then it went down again on the green vertical line. And so it was trying to get back, trying to go up, but you can see the prices were still meandering down throughout this whole thing. The trend trio was remaining under zero through the whole thing. So it could have been one of those sell-offs by some hedge fund that just was dumping enough each day to keep the thing relatively speaking in where it should be price-wise. You don't know that stuff. You can't think about who's behind the scenes on a long-term basis. You definitely want to think about stuff on the short-term basis and who's moving what. And you won't know till later on, and then you're not sure that what you think is fact. So indicators do not lie. You just need to be able to read them. This is a powerful example of a gap, of a situation where it almost qualifies as a gap up, but when you see that doji the following day, that is an excellent opportunity to get into a long green candle. Hope this video was informative. I am truly amazed at what you can read out of this system. I think just this video alone gave you that insight into seeing the strengths that you can pick up, the positions, the indicator positions, and how they're related to, in this case, an uptrend. So just lots of information. It's what technical analysis is all about, and it is exciting.